There is one number in India's draft tax rules that most NRIs and returning professionals have no idea about. And depending on which side of it you fall on, it either keeps you in a simple lane or legally requires a CA to verify your foreign tax credit claim. Cross it in foreign taxes paid, and the compliance bar rises. Miss the forms, the deadlines, or the documentation, and your credit claim becomes very hard to defend. Stick around because we are breaking down exactly what Draft Rule 76 is proposing, what it means for you, and how to make sure your FTC file is actually bulletproof. Hi, my name is Sagar Soman and welcome to another episode of the Offshore Advantage. Before we begin, a quick compliance note for you. This is based on draft proposals placed for stakeholder consultation under the Draft Income Tax Rules 2026 and the draft forms linked to the Income Tax Act 2025. Final rules, forms and timelines can change before notification, but the direction is already clear. And that direction is what you should plan ahead for. This video matters to you if you are returning to India and moving into RNOR or ROR category. You have overseas salary, RSUs, dividends, interest, pension income, or you are a resident in India and you have meaningful foreign income and foreign taxes paid. Because Rule 76 is framed for residents and FTC becomes relevant the moment the foreign income is being offered to tax in India. Now here's the key point that people miss. DTAA or Double Taxation Avoidance Agreement is the treaty rulebook. FTC or Foreign Tax Credit is the claim mechanism. DTAA tells you who can tax and how double taxation is avoided. FTC is where you say, I have paid foreign tax on this income, give me credit in India to the extent law allows. So FTC is not a feeling, it's a computation plus evidence plus procedure mechanism. And the draft rules are tightening the procedure and evidence side. Let me start with a simple real world style situation. A returning professional becomes resident. Foreign income is offered to tax in India. They claim foreign tax credit and they assume the system will simply reduce Indian tax and move on. Then comes friction. Not always because the person is ineligible, but because the documentation is incomplete. The computation is not mapped properly. The exchange rate logic is wrong, or the tax is disputed and the timing is off. So the compliance pain is not you don't deserve credit. The compliance pain is prove it correctly within the prescribed route. And that's exactly the direction of the draft rules. Now, before we go into what is changing, one line that will keep you legally safe and practically sane. Under Draft Rule 76, FTC is not a self-claim in isolation. It sits on Form 44 plus supporting tax certificate or statements plus proof of payment or deduction. That is the architecture. So when people say, I'll just disclose it and claim it, no. Disclose it, compute it, and support it with the prescribed documents. Now I'm going to break the changes into three shifts. I'm going to save one specific number for later. This is the compliance fork in the road. It determines whether you can handle your own filing in the simple lane or you are legally required to enter the verified lane with a mandatory audit. First shift. Form 67 route is now being reworked into a new FTC statement format called Form 44. Second shift, the draft introduces an accountant verification trigger for bigger cases. Third shift, disputed foreign tax gets a formal workflow, including a separate intimation form, Form 45, and a strict timeline once the dispute is settled. Now let's go step by step. Firstly, Form 44. Some people will try to downplay this and say Form 67 already had country-wise and source-wise reporting, nothing is new. That's only half true. Yes, structured reporting existed, but the draft is making the reporting more data-driven and standardized. Now let's talk about the second shift, and this is where the self-declaration mindset actually breaks. There is a trigger in the draft rules. Cross it and your FTC statement is not expected to remain a simple self-filed statement. It moves into verification expected territory. Here is the trigger. Form 44 is required to be verified by an accountant if the assessee is a company, or in other cases where the foreign tax paid outside India for that tax year equals or exceeds 1 lakh rupees. That's the proposed compliance trigger. So no, this does not mean every FTC claim needs accountant verification. But also yes, it means the moment your foreign tax paid becomes meaningful, the compliance bar rises. And one more important nuance that many people will miss. The draft also extends that verification logic to Form 45. If your Form 44 for that year required accountant verification, then the Form 45 intimation for disputed tax settlement also requires accountant verification. So the bigger case lane is consistent across the process. Now let's talk about the core mechanics. FTC is capped. Credit is the lower of Indian tax payable on that doubly taxed income and the foreign tax paid on that same income. So paying high tax abroad does not automatically guarantee you full credit in India. And the draft rules also make a very clear boundary. FTC is available against tax, surcharge and cess, but not against interest, fee or penalty. So if someone says, I paid a foreign penalty, can I get credit in India? That's outside the FTC credit bucket. Now, the most misunderstood part, and that is where your file can go wrong even if everything else is correct. Disputed foreign tax. A foreign tax demand is raised, you disagree, you appeal. The matter is pending. Many taxpayers still try to claim credit immediately because emotionally it feels like tax has been demanded. Draft Rule 76 takes a cleaner approach. No credit is allowed for disputed foreign tax unless you satisfy the settlement route. The settlement route is strict, so timing is everything. Once your foreign tax dispute is finally resolved, you have a hard deadline. You must provide a settlement order, proof of payment, and a formal undertaking that you won't claim a refund later. All of this has to be filed via the new Form 45 within exactly 6 months from the end of the month in which the dispute was settled. Miss that window and your FTC claim becomes much harder to support within the draft procedure. And for this settlement route, the draft specifically requires an intimation in Form 45 along with settlement and payment evidence. So the FTC roadmap becomes dispute pending, your credit is on hold, dispute settled, you should submit your proof of payment, sign the undertaking, and file Form 45 within the deadline. Only then can the credit be allowed for the year in which the income was offered to tax in India. It's a cleanup move by the tax department to end the guesswork. It forces taxpayers to separate final tax from disputed tax, and it prevents premature credits that later become reconciliation nightmares. Now let's talk about timelines because this is where most genuine taxpayers get trapped. The draft doesn't want FTC to be an afterthought. It hardcodes a furnishing timeline. Form 44 and the supporting certificate or statement are to be furnished within 12 months from the end of the relevant tax year in which the income has been offered to tax in India. And this is linked to the return being furnished within the prescribed return timeline. And if an updated return is being furnished, then Form 44 and the supporting certificate or statement, to the extent it relates to the income included in the updated return, must be furnished on or before the date you furnish that updated return. So practically, if your return filing is being done late or revised or updated, FTC paperwork cannot be treated as we'll do it later. The draft is pushing it to be aligned with return. Now another area where sloppy work creates unnecessary trouble. Currency conversion. FTC is computed by converting the foreign tax payment currency at the telegraphic transfer buying rate on the last day of the month immediately preceding the month in which the tax has been paid or deducted. So if your FTC file uses random spot rates or average rates, Google rates or conversion without a clear basis, that's an easy target for queries. Now let's get extremely practical. Under Draft Rule 76, credit of foreign tax is allowed only on furnishing specific documents. But which documents? First, Form 44, the statement of foreign income offered to tax in India and the foreign tax deducted or paid, verified in the manner specified. Second, a certificate or statement specifying the nature of income and the amount of tax deducted or paid. This can come from the foreign tax authority or from the person responsible for deducting such tax, or it can be signed by the assessee. But if it is signed by the assessee, then it must be accompanied by proof, either acknowledgement of online payment, challan, bank counterfoil for tax paid, or proof of deduction where tax has been deducted. So the draft is not saying only foreign tax authority certificates will work. It is saying whatever statement you are using, you must support it with the prescribed proof. Now let me give you a simple mental model because it keeps your retention safe and compliance safe. Think of FTC in 3 buckets. Bucket 1, clean FTC. Tax is final, proof exists, income mapping is clear. Bucket 2, high value FTC. Even if it is clean, the foreign tax paid is meaningful, so verification expectations rise. Bucket 3, disputed FTC. Tax is not final, so credit is blocked until settlement, then Form 45 route. If you sort your case correctly into the right bucket, your compliance becomes calmer and more defensible. Now here is your FTC file checklist. Keep it ready even if the final format evolves because the logic will not change. 1. Foreign income working, clearly mapped to what is offered to tax in India, year-wise, source-wise and country-wise. 2. Foreign tax proof, whether withheld or paid, supported by certificate or statement and proof of deduction or payment. 3. DTAA mapping where relevant, including which article you are relying on and why, because Form 44 captures treaty article references in a structured way. 4. Exchange rate conversion working using the prescribed TT buying rate method. 5. If any portion of foreign tax is disputed, keep it segregated. Keep settlement trail and payment proof ready and be prepared for the undertaking requirement that no refund has been claimed or will be claimed, because without that, the disputed tax credit route collapses. Now, a practical line that I'll say bluntly. Even if some judicial outcomes have granted relief despite procedural lapses, that is a litigation territory. It cannot be a filing strategy. So, the professional strategy to keep the FTC claim defensible within the procedure is as given here. So now the bottom line, the draft is not taking away FTC, it is raising the discipline around FTC, structured reporting, prescribed documents, time limits and verification for bigger cases. For small FTC cases, the friction may remain manageable. For meaningful FTC cases, the era of casual self-claim is shrinking. And finally, one more reminder, these are draft proposals placed for consultation. Final rules, forms and timelines may change, but if your documentation discipline matches this draft direction, you won't be caught off guard. If this helped, subscribe for weekly NRI tax and cross-border compliance updates and share this with other NRIs who still believe I'll just declare it and foreign tax credit will automatically come.